The $7,500 electric vehicle tax credit may already be on life support. This is one of the policies that President Trump, or President-elect Trump, has targeted as something that wants to be repealed as part of a comprehensive tax reform. This was reported by Reuters and other sources on Thursday. EV stocks really took a hit, and there's a good reason why. The $7,500 is a direct savings, and this is a competitive market. This is not something where that $7,500 just doesn't have a real impact on the pricing for electric vehicles. If that doesn't exist, prices need to go up $7,500, and that's going to make them less competitive with traditional ICE vehicles. Now, Tesla and Elon Musk has reportedly said that they're supportive of ending this tax credit, but that doesn't really make sense. This is a company that is the biggest EV maker in the US. It is a huge beneficiary of this tax credit, and we have seen just over the last 2 years that Tesla is very price sensitive. When the EV tax credit was supposed to go away in late 2022, they had to reduce their prices to offset that early in 2023. When demand fell in 2023, they had to reduce their prices to increase demand. They are subject to the laws of supply and demand, and so if that $7,500 goes away, it's going to have a huge impact on Tesla's income statement and profitability. I want to get into exactly what I mean in those numbers. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's look at just how much Tesla benefits from the $7,500 tax credit. I'm going to show an example with the Model Y, Tesla's best-selling vehicle. This is the way that Tesla presents its pricing, financing the Model Y. $4,000 down, or 8%, that's what they say right here. And then this toggle includes the $7,500 tax credit and savings of $100 per month. If you untoggle this and take that tax credit away and the savings away, the price goes up 56% to $725. Now, $100 of the savings that you see in this 481 is actually related to this $100 savings that you can see right here. So that's part of the increase, but a huge percentage of the increase is the tax credit. Leasing is another area where right now, even without including the $100 per month, you can lease a Model Y for $350 per month. That is because Tesla gets that $7,500 tax credit. So the margins are improved directly by Tesla because of this tax credit. The other thing that we can look at is Tesla's cash flow, the cash that they're generating from operations compared to the number of vehicles that they're delivering. Over the past year, Tesla has generated $14.479 billion worth of cash flow. They've also delivered 1.78 million cars. Divide that cash flow by the number of cars delivered, and you will see that there is a cash operating margin of $8,100 per vehicle. So you take away that $7,500 tax credit, and that's only $600 of cash flow per vehicle. Now, not every one of those vehicles is produced in the US or sold in the US. So that's just an overall number for Tesla. But that gives you an idea of how reliant Tesla is on these subsidies in countries like the United States. The other line item that could potentially be under threat is this right here, the automotive regulatory credits. Tesla has always been really opaque about this, exactly who's paying for it, what regions they're coming from. But over the past year, $2.5 billion worth of revenue came from these credits. And this is money that goes directly to the bottom line. It becomes directly cash flow and net income. So taking any of that away, especially if it's offset by other automakers increasing their electric vehicle production, which is going to reduce demand for those credits, that's going to impact the company's margins. So if Tesla's cash flow from its core business essentially goes away because of the reduction of these credits, and that's very possible, they still have a ton of spending that they're doing related to the AI build out. And that's not going to slow down because Elon Musk and Tesla has really bet the company on artificial intelligence and robotics in the future. Just over the past year, $10.9 billion worth of capital expenditures. That's not on building new plants to build more automobiles. In fact, they're reducing the number of automobiles that are being delivered. So most of that is going into this AI build out. So there's going to be a huge impact on Tesla if this $7,500 tax credit and any other subsidies that are involved. We also have subsidies related to building and assembling batteries in the United States, manufacturing electric vehicles in the United States. The IRA was a huge beneficiary for all kinds of renewable energy companies. So if those subsidies are rolled back, Tesla is going to feel a massive impact, and its competitors may not. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, most of Tesla's legacy competitors don't have the same challenge because they're not as reliant on electric vehicles. Remember, every single vehicle Tesla sells would be impacted by any changes in the EV tax credit and even that resale value. There's a $4,000 credit for reselling vehicles. So that may deter some customers from buying vehicles as well. So a lot of impact directly on Tesla, but other automakers are not going to be as directly impacted. GM is one of those competitors. They have sold 300,000 electric vehicles in the US, but that's all time. In the most recent quarter, they sold 32,095 electric vehicles. Now that's going to increase later this year and into 2025, but that's about 1% of the number of vehicles that they're building. So will those vehicles be less profitable if the $7,500 tax credit goes away? Absolutely. But the other vehicles GM is selling, the trucks, SUVs, small crossovers, all of those vehicles are not only going to be just as profitable as they previously were, they may actually be more appealing because you're not going to be competing with a product like Model 3 or the Model Y based on price. So the competitive dynamics, if the EV tax credit goes away, actually shifts towards these legacy automakers. So the devil will be in the details, but the fact that this is being discussed this early in the transition, I think is going to be potentially devastating for every electric vehicle focused company and even Tesla. And there's one more example I want to point to. And this is related to what happened last time Trump was president with solar energy. Solar energy, you might remember, grew significantly during the Obama administration. What happened as soon as Trump took office? This was not all directly related to Trump, but installations dropped between 2016 and 2017. They remained low through 2018. It wasn't really until 2020, and when that pandemic hit, that installations picked up again. It wasn't just installations that dropped. The number of people working in the industry dropped. Policy and subsidy are very important in some of these emerging industries. And we are now at the point with electric vehicles that we're talking about cost parity with ICE vehicles. And that means that they have to play on the same playing field. That means that supply and demand matters, price matters, features matter. Tesla is not going to be immune to this. And so I think this is going to be fascinating to see how this plays out. But if these credits go away, this could have a massive impact on Tesla's revenue, net income, and cash flow in future years. Something to think about. Let me know what you think about this in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.